Welcome to the Man from Macro, and this week we're going to be looking at the dilemma for policymakers when markets react positively to the potential for a policy change before the underlying economic data truly justifies a change in a policy stance. And what do we get, or what do we see over the last few days? Well, coming into the long weekend, we saw a positive reaction from US equity markets on those slightly weaker than expected non-farm payrolls. Now, the headline number did beat, but there were those revisions of about 110,000 to the previous 2 months. And we've also got this ongoing scenario from China where policymakers keep on adding new macro-prudential policies, or they do some loosening because some of the data remains fairly weak. And this morning, on Tuesday, we again saw some PMIs, particularly on the services side, that missed expectations. And the Aussie dollar, in fact, fell about 1.3%. So again, we're still seeing that outlook for data quite poor. And the problem is, if we get the reaction from markets that's positive, then it's going to tie the hands of policymakers. So first we saw the S&P and the Nasdaq, and the S&P obviously has had a few days of downside, but now has basically bounced for a couple of days. Now, some of this was helped by positioning, and something that Imran Lakha of Options Insight pointed out, which is that market makers were long gamma coming into this weekend, into the long weekend. And as we saw the market rallying, we actually saw volatility falling at fixed strikes. What that means is that implied volatility was falling at those specific levels, and we got down to around about 9.75 or 10 in the front months, even though the market was realizing around about 13.5%. So these were market makers closing out and selling down those long gamma positions because they'd been perhaps expecting something a little bit more negative and a little bit more of a move in the market, but maybe to the downside. And then secondly, we saw again the SXPP, which is the basic resources from Europe, something I've talked about before. It started to break down through its neckline, but with all this positive response, or at least this policy response from China, we have seen that market bounce back up. And yet it's not being confirmed by the Aussie dollar. The Aussie dollar and the basic resource sector usually go hand in hand. The Aussie dollar is weaker, and yet we've seen this bounce in the mining sector. A little bit of weakness today on the Tuesday. So what are the data points that they've been looking at, and are they sufficient yet for a true policy reversal? Well, we've got a mixed bag even there. We've got the ISM, and the ISM manufacturing came in recession territory, or at least in contraction territory below 50, but it has had a little bit of a bounce. So we're not yet at the position where we'd say that the ISM is commensurate with a true recession. In fact, when we've seen the ISM below 50, it has needed to be coincidental with significantly higher or significantly moving higher unemployment rates. And as of yet, yes, we have ISM still in the contraction territory, but now bouncing with some forward indicators suggesting it could bounce back into expansion territory. And yet we're not getting the data from the unemployment side of things. On that front, we have seen a big pullback in JOLTS job openings. And that was one of the reasons why people said, okay, here we are, we're now coming to it. But when we look at this chart of the JOLTS jobs openings, we can see that, yes, it's moved down significantly, but it's moved down from that huge pop that it had post-COVID. All it's done is gone back to that rather dramatic trend that's been in place since around about 2010. So yes, it's fallen just below there, but this is still quite an impressive number of job openings. Now, the job openings data is prone to being, to double counting, etc. But people do use this as a sentiment indicator. Yes, it's pulled back, but I wouldn't say it's pulled back to a level which suggests a significant problem in the jobs market yet. And that's also borne out in the unemployment data, which has had a pop. It was expected to be 3.5%, moved up to 3.8%, but it's only just started to move. And as we can see here, we need to see unemployment moving much more dramatically if it's to be in line with the way that we've seen unemployment rising during recessionary events. This suggests we're still in that early phase where unemployment turns normally before a recession, sometimes quite significantly so. And so far, it has only just started to turn. But the market has got excited. The market thinks that the chance of that expected pivot, this is where they start cutting rates, is going to be imminent. And at the moment, the Fed funds is suggesting that the peak of interest rates is September this month, and it will start to reverse. Now, remember, Fed funds is working out an implied interest rate using 100 minus the futures level. So if the futures level is at 94.5, it implies 5.5% interest rates. If it's at 96, it implies 4% interest rates. And currently, the market expects interest rates to fall to around about 4% by the end of next year. But so far, this pivot has just been pushed out through the months over time. We actually haven't seen a pivot yet, but nonetheless, the market always tries to price for that. But whilst the market's been doing that, been trying to price out these interest rate hikes and looking for this pivot, we're getting some other data points which suggest that CPI may be stickier than people think. We've seen WTI, this is front month future on the WTI, this is the oil future, crude oil, has just broken to the highest level this year. It now looks like it's heading towards 90. It looks like it may even be breaking out of basically a sideways range-bound arena. So oil is moving higher, and this matters because, as you can see on this chart, over the last few years, where oil has gone, CPI has gone. So CPI has been dropping quite dramatically over the last few months, but if oil's moving higher, we should expect CPI to start becoming a little bit stickier rather than falling continuously towards that 2% level and ultimately that 0 level. So we have to be careful that if oil is moving higher, then maybe CPI starts to move as well. And this comes at a time when core CPI, which has also rolled over, still remains significantly elevated. Now, nearly every prediction is that this CPI, core CPI, ex food and energy, will continue to fall. But it's the pace of that fall that matters. If it takes a long time for that core CPI to drop, then the Fed and other policymakers are going to be a little bit nervous about reacting too quickly. And of course, as we move into next year and people want to win votes, we could start to see fiscal come into the mix, which historically is one of the most inflationary types of policy that you can have. So why does all this matter? Well, it matters because throughout all of this, where we've seen these moves in things like equities reacting positively to the expectation that policymakers may want to put on the brakes or even reverse, we're not seeing the big move from bond yields. Bond yields have pulled back a little bit. Here we can see the 10-year yield and the 2-year yield, but they remain very, very close to their recent highs. Therefore, there is still this potential asymmetric risk that if they break out, they squeeze significantly higher. So the bond market is not quite as optimistic as the equity market. They may be seeing that the Fed has some work still to do. Or the other element to this is if you have unemployment that remains relatively low and equity markets that remain relatively high, that implies that growth should be relatively robust. And herein lies the dilemma. If the Fed is basically looking at the market and seeing equities that are higher, unemployment that's relatively low and sticky, well, then there's no incentive for them to cut rates. There may be an incentive to pause just because, well, we've gone a long way in this path already. But unless we're actually starting to see real reasons for a pivot, actually all the information they're getting from the marketplace is that they can carry on hiking rates because the reaction from equities to every piece of bad news is that here comes the pivot. So this is the problem that the Fed faces, is that the market keeps reacting in such a way that it ties their hands and prevents them from doing the very things that the market wants. Therefore, maybe the Fed needs to do more to actually get the market, particularly the equity market, into a place where lower equities drive CEOs to actually shedding more jobs at a faster rate so that unemployment goes up. So basically what we've got here is this scenario where we have to think about, we have to be careful what we wish for. If we see markets wishing for a Fed pivot and pricing for a Fed pivot before the data justifies a Fed pivot, we might get the exact opposite. So I hope you've enjoyed this. Please do subscribe and ring the bell if you want to get the latest updates. And obviously all of this is for education and engagement purposes, and none of it constitutes investment advice.